Good morning, good afternoon, good evening, wherever you're watching me today. My name is Peter. Welcome back to Invest with Peter. So today I'm going to be talking about, the main reason why I think cryptocurrency is a good buy at this point than stocks. But before then, if you see me for the first time, please subscribe to the channel. My name is Peter. As I bring this, video, important information that you're probably going to need every week, once a week. And if you've seen me for the first time, well, I just drop my video once a week and that's it, right? So if you like my content, please subscribe to the channel, like, and put your comment down below. So today I'm going to be talking about some couple of things. I'm going to be talking about UK economic crisis. I'm going to be talking about, the earnings that's coming, the banking, they've been reporting better than the expected earnings. I'm going to be talking about why you need to start looking at cryptocurrency now than putting your money in stock and all that ETFs and all that stuff. But all right, let's go straight. So today let's talk about UK crisis at this point. It's been a while that UK economy has been in crisis, but people have been like, well, UK is not third world country. Why are they behaving like this? Why are they actually, looking at economy this way? Why is Kwasi Kwarteng, pushing this kind of agenda to the front? You don't cut tax during economic crisis. You rather tax people more. That's not what Economics 101 taught us in school and all that stuff. Who does this? Who cut 35p out of £1 of the great 1% in the community, in the society, and all that stuff? So now this crisis has made pound sterling to drop drastically, and it's gone 40 years low compared to previous, exchange rate. And it's put the world economic into crisis, and even IMF was telling UK that UK need to be very careful in the economic projection and all that stuff. You don't push this agenda to the front and all that stuff in this kind of environment. Inflation is high, crisis left and right, economic crisis. China is not opening up fuel fully. Demand need to be crushed. See all these issues that come in play when you're trying to bring the inflation down. But UK politicians are probably being, not being ignorant of what's happening or not actually looking at these markets and responding to markets accordingly. So Liz Truss actually said, well, Kwasi Kwarteng, your time is up. You need to go now and all that stuff because of what he introduced, cutting taxes and all that stuff. And all of a sudden, they bring another, chancellor, which is Jeremy Hunt. So this guy actually came out and said, well, I'm going to write off all this stuff that this, government is pushed forward, because that's not what we need at this point. So which is going to lead to some thought I'm going to be talking about today. The energy supplement the government, market energy price cap that UK government is put in place is going to be only for 6 months. So from April next year, they were like, we're going to readdress the case again. It's not going to be 2 years that Liz Truss was pushing, and this is going to probably bite into people's pocket, because if the price cap stopped by April 2023, then what's going to happen next then? Well, don't let's go much into that. So let's talk about the banking earnings before I go to the real topic of today. I don't want to waste time. I just want to go straight into the point. Bank of America reported their earnings on Monday, and it was better than expected. And they gave us some clues about what's actually happening in the market at this point. Before I go forward, right, last week, the CPI came out. I've not even made a video on that. CPI came out 8.2, and it was actually higher than what the market was expecting. The market was expecting 7.8, 7.9, but still came out higher than expected. But if you look at it month by month, it's been coming down from 8.5 to 8.3, 8.2. So gradually, I think we're seeing the changes coming down on CPI report and all that stuff. If not because of the energy crisis, I think it's probably going to be lower than that, what we're seeing at this point. So because the energy crisis is there, that's what's keeping it at that top. But market is probably going ahead of itself by actually projecting 7.8, 7.9. I believe market is actually doing well, but it's not looking good in terms of where the Fed is want us to be at this point. So that's why we're going to get 75 basis points November. There's no question about that. Though even if it's for me, I would have preferred 50 basis points, but I think the market has probably priced in 75 basis point at this point just because of that, right? So let's go back to the banking report. So the Bank of America reported better than earning, and they actually said, well, people are still keeping more money in their bank account. People still have, purchasing power. People still taking loans to buy stuff. People are still looking to get new things and all that stuff. So as a result of that, the job market is still looking solid. And guess what? The Feds are looking for the opposite. They don't want the market to be strong. They want the market to be weakened. They want demand to be crushed. But people still have their cash stash in the bank. So they say, well, our projection is market still look good. People still keeping enough of money in the bank balance, and they still have strong buying power and all that. So that's why, the report said the report came out very stronger than what the market was expecting. Even JP Morgan Chase reported a better than expected earnings, and that's why you saw the market rally on Monday, because people were still thinking, well, market is still strong regardless of what the Feds are doing, trying to break down the inflation, crushing the inflation by raising rates, and it's like it's not really working. But if you look at it technically, I think it's actually working, but because the data the Fed are looking at is like, they're looking at, they are data driven, just like they said, but the data they are looking at is not forward looking, it's backward looking. It's like driving and actually looking at your rear mirror. You are not looking into the front, because the data they're talking about has happened in the past. So they're using the past data to judge what is to come in the future, which is quite wrong. I think they need to use that data to confirm, well, what we're doing is working. Inflation is coming down gradually. It's not going up. Inflation has peaked. Everyone believes that. So it's actually working, but it's not working aggressively like we want. So let's keep on doing this, but let's do it in a lower rate. Instead of going 75 basis point all through, I would have preferred them to go 50 basis point, because the more they push 75 to the front, the more they have the chance to send us into a deep recession. And that's not going to be good at all for everyone, and all that stuff. Though some people, some hedge funds, the shorts, they want that recession badly because they want to buy in when everybody's, wiped out and all that stuff. That's what they enjoy. That's why on CNBC or on Yahoo Finance, you see them come up and say, well, recession is inevitable at this point. There's no way we're going to get rid of, we're going to be out of recession. It's going to be deep. And you have so many YouTubers saying it's going to wipe everybody out. Some thumbnails on some YouTubers are like, don't, you have no choice at this point. You're going to get wiped out. There's no way. Get out now with your 40% left. Even some people who have 60% of their portfolio wiped out, they still want them to get out with the remaining 40%. Who does that? We are in the market to invest for the long term, not for the short term. If you're treating your portfolio like your pension, everything happening around you wouldn't matter at all at this point, because if you run out now, when we get into the bull market, you want to run back in again, you ain't gonna make any money. So whoever stays in with the wave and the ride and all that stuff actually come out shining better than somebody who comes in, run out, and probably want to come back in again when market is up again. That's why you see people complaining every time whenever we have a bear market, because they always run in and run out. They're running when the market is green, run out when the market is red. That's not the way to trade, and that's not the way to invest for the future. So let's go to the reason why I said I think and I believe cryptocurrencies are a good buy at this point than buying stocks. See, if you look at big companies, Microsoft, Apple, Amazon, and all these big companies, right? They've been down like 20%. I think Microsoft is down probably 17% or something this year. In this bear market, and Apple's down like maybe 17 or 16 or 18%. I can't tell specific numbers. So Amazon is down as well. Apple is down as well. And if you look at Tesla is down like 50 or 50 something percent, year till date and all that stuff. And some companies are 90%, 80% down, 75% down, right? But if you look at crypto, right, especially Bitcoin, if you look at Bitcoin has actually gone down to the level, I think the lowest Bitcoin has gone was $17,800, something like that. And since we touched that, if you check your chart, if you check your chart, you're going to see since we touched that, we've not gone back to that low again. So I believe Bitcoin for now has probably bottomed at this point. That's why you see Bitcoin being resilient as 19,000. Regardless of what happened, I've been monitoring this chart and I've been looking at it that regardless of what the market, the bad news that is coming to market, dragging the Nasdaq, S&P down 4% in a day, Nasdaq down 5%, 4%, S&P, Dow Jones 3%. Bitcoin has kept its 19,000 level, 18,000 level, and if you look at Ethereum as well, Ethereum is being like 1,200, 1,300 regardless. So every other thing come down, it just stays at that level. That's telling us something, guys. For those who understand the chart, you know that that is probably giving the strong support at that level, and I think with that pattern, we can probably say, well, at this point, whatever is going to bring Bitcoin lower than 18,000 will be a very, very, very bad thing that will probably drag Nasdaq and S&P to like -7, -10 before Bitcoin breaks that 17,000. If Bitcoin break that 17,000, expect Nasdaq to probably have gone down like 10% or something like that. But so because the resistance at around that 17,000 is very strong and at the level of 19,000. So I see Bitcoin being like, I won't say for maybe for now, Bitcoin especially has probably bottom as at that level, and I'll be looking at that again to buy in when I see Bitcoin again at 18, or if I can wait, if I see Bitcoin touching 17,000 again, I'll be doubling down, and that's my projection. And I think your money is probably saved now. I'm not your financial advisor. I'm just telling you what I'm going to do, because I always say this in my video. I'm not telling you what to do. I'm telling you what I'm doing. And if you want to follow what I'm doing, well, that's at your own risk. I'm not a financial advisor. I just come here to teach, to educate on what I'm doing with my portfolio, what I'll be doing, and what I think the market is doing at this point. So I'm not telling you to buy anything, but I'm just saying if I see Bitcoin goes down to 17 or lower 18, I will be buying in again, and I'll be looking at Ethereum at 1,100 or 1,200, lower 1,200, and I'll be buying heavily at that level. Because if I start buying into some stocks now, we don't know when companies, how they're going to react on a recession. So if I'm going to even buy any company now, I'm going to buy any stock now, I'll be looking at doubling down Microsoft, Apple, Amazon, Google, and all that stuff. Those companies I know, and I'll be looking at some companies, consumer staples, because regardless of what happened, the recession and all that stuff, people are still going to brush their teeth. People are still going to use soap to wash themselves. Women are going to use makeup and all that stuff. So I'll be looking at that consumer staples if I'm buying into stocks. But at this point, I'll be looking at cryptocurrency, because that's where the money is actually steady a little bit. It's not that volatile like we had in the past. So I think that's the best place now to keep your dough and all that stuff. So I don't want to waste your time more, but I'm telling you now that this is the time to start looking at cryptocurrency. I'm not suggesting any crypto. That's why I'm saying cryptocurrency. So whatever cryptocurrency you want to buy, but please just stay away from probably... Well, if you want to say Shiba, I trade Shiba, I trade in and out of Shiba, I don't have one at this point, but I'll be looking at if Shiba drops to under 0.0010, if I see 0.0009 or 0.008, then I'll be getting in the game. But at this point, I am not buying Shiba, at this point, because I don't think Shiba has actually touched the floor at this point. So, but for other cryptocurrency of your choice, you need to start nibbling in. If you want to start nibbling in now at your own, at your own risk. So, but as for me, I am actually looking at Bitcoin and Ethereum at this level. And once I see those numbers, I will stop at nothing and start buying straight away. So I will just be looking at that at this point. And please be careful who you listen to now. We have so many doom and gloom sayers out there telling you this and that. Treat your portfolio like a pension and you'll be all right. All the noise around, all the people shouting, hey, this and that will be just like the noise on the road. When you're driving, just hear this, the noise wiping out your windscreen and windshield and all that stuff. So treat it like that. Like it's just a wind that is just blowing. Don't concentrate. Don't let this thing disturb you and all that stuff. Do your daily job. Be happy, treat yourself nice, and treat your portfolio like a pension. You're not retiring soon now, so if you are like 50s, 60s, then you start thinking about ETF and those stable places. But if you're in the 30s, 40s, 20s, just keep dollar cost average and just leave it there for 10, 15, 20 years, and you'll be all right. You'll come out shining than your mates who are probably running in and out of the stock market. So, well, that's it for today. My name is Peter Ads. If you actually like the content, please subscribe to the channel, and I'll see you on the next one. Bye.